Next, we'll explore the important information and disclosures required for variable rate credit plans. A variable rate credit plan is an arrangement where the annual percentage rate, or APR, may increase or decrease during the repayment period, typically based on market rates. Let's understand what makes a loan a variable rate credit plan. A loan is considered variable rate if one or more future interest rates cannot be calculated at closing. It's important to note that the fixed rate buydowns, step rate, and graduated payment mortgages are not inherently variable rate mortgages because their future interest rates are known and calculable at the time of closing. One common type of variable rate credit plan is an adjustable rate mortgage. An ARM is secured by the borrower's primary residence, has a term longer than 1 year, and features an APR that will be readjusted after closing. For such loans, the Truth in Lending Act mandates additional disclosures to ensure borrowers are fully informed. Let's go through these disclosures. The first is the Consumer Handbook on Adjustable Rate Mortgages, or the CHARM booklet. This consumer-friendly document explains the features of adjustable rate mortgages, introducing terms such as index and margin. The CHARM booklet can be published by the Board of Governors of the Federal Reserve System in the Office of Thrift Supervision or a suitable substitute. TILA also requires a disclosure for each variable rate program that interests the consumer. This disclosure must include notification that the interest rate payment or loan term can change, disclosure of the index or formula used for adjustments and where information about it can be obtained, an explanation of how the interest rate and payment will be determined, including how the index is adjusted, encouragement for consumers to inquire about the current margin value and interest rate, notification of any interest rate discounts and the consumer's ability to inquire about the discount amount, the frequency of interest rate and payment changes, any rules regarding changes in the index, interest rate, payment amount, and outstanding loan balance, including limitations, negative amortization, and interest rate carryover, a historical example or initial and maximum interest rates and payments for a $10,000 loan, depending on the creditor's choice, as well as instructions for consumers to calculate payments based on the disclosed loan amount. In addition, variable rate contracts secured by the borrower's dwelling must state the maximum interest rate as required by TILA regulations. Lenders are also obligated to provide cost disclosures, including a payment summary in the form of a table stating the following: the initial interest rate and corresponding monthly payment. For adjustable rate or step rate loans, the maximum interest rate and payment during the first 5 years, along with a worst case example showing the maximum rate and payment over the loan's life, as well as the fact that consumers might not be able to avoid increased payments by refinancing their loans. That wraps up our discussion on disclosures. We will now move on to fees under TILA.